All right, hello BiggerPockets guys and gals, this is Jesse Fragale coming at you. We're gonna do a quick video today on commercial lending and what a lender is looking for in you, and a little bit about types of loans. Now I say quick because I'm about to watch the Raptors kind of take it all with the Warriors. If you're watching this now, you realize that's already happened, or I look like I've got egg on my face. So without further ado, let's roll the intro. Okay, so we got a lot of questions about commercial lending and how to move from a residential property into commercial loans, or how to finance for commercial real estate, and that would be under the umbrella of multifamily apartments, retail plazas, industrial facilities, offices, and the like. A little bit of nuance, but it's not as complicated as everybody makes it out. So you always hear different types of debt. You hear mezzanine debt, you hear bridge loan, you hear construction financing. I'm going to try to take it all into three simple buckets when it comes to the type of lenders. I think that this will basically give you an understanding of the type of loans that, generally speaking, are being done on the commercial side. So the three loan types the three lenders are the regional lenders, the agency debt, and the commercial mortgage-backed securities market. So I'll start with the last one first, just because it's not going to be a large component. The CMBS market is basically, it's what the movie The Big Short was predicated on, the great financial crisis. So CMBS are pools of mortgages, and what happens with those is that the originators of those mortgages aren't actually the ones that create the CMBS financial instruments, and that's exactly what they are. Think about it this way: it's mortgages throughout the United States that gets pooled. Wall Street takes it as a financial instrument that pays out a certain return based on its overall risk. So the tranches will have each different level of risk. So if there are defaults in the mortgage pool, the people at the top usually won't get hurt. It's going to be the first one with the highest risk that gets, that feels it, and then the second tier, and then the third tier, and so on. Now, the reason I am saying we're going to start with this is because for most people breaking into commercial real estate, you're not doing this type of loan. You're probably going to be in the $2 million value in terms of the debt. If you're up at 10, 15, congratulations, that's unreal if that's your first commercial deal. So we'll go back to the two main ones I think we should focus on, and that's regional debt and agency debt. So regional debt is going to be the closest thing to if you've ever done a residential mortgage. It's going to your bank or hiring a mortgage broker, finding a loan. A lot of times these are going to be fairly conventional. They're going to be an interest rate that's not absurd. It's going to be a amortization. They'll do 5-year, 10-year. You might do 20 or 25, really depends on the market. And this is just your vanilla debt. Like, they will look at this as debt that is recourse debt as opposed to non-recourse debt. So we don't really like that, because they can not only take your property, they can go after you personally. But I mean, everybody has to start somewhere when you're scaling in real estate. So secondly, the agency debt. Now, agency debt is going to be your Fannie Mae, Freddie Mac, and the reason it's called agency is because these are effectively government subsidized agencies. In Canada, there is the equivalent would be what they call the Canadian Mortgage Housing Corporation, CMHC, and they will do a very similar thing that Fannie Mae and Freddie Mac do. Now, with this type of debt, it's very good if you can get it. It is actually the debt that I have on an apartment building just outside of Toronto, and that type of debt usually comes with a lower interest rate, and they're a little bit more creative on how you can refinance the property. And we are going to do a video on refinancing. It's been something that has been requested, so that's coming up. But anyways, the ability to be creative when pulling money out of the property in a couple years down the road is going to be something that you're going to be able to do with this agency debt. So those are the broad types of lenders and types of loans that you can get. But I think what's more important to the audience in the BiggerPockets community is the people that have asked the question, what do I need to do to get approved? What does the practical process look like? And I'll tell you from experience, you need to come in with I believe, a couple things. Number one, you have to know what you're investing in. So if you are looking at multifamily or if you're looking at offices, you need to know, first of all, that, and then you need to know the markets that you're actually looking into. When lenders are looking at people that are breaking into commercial real estate, yes, they will focus on the property, the rent roll, the economic feasibility, the area, demographics, but a lot of times they're gonna focus on you. So having your finances in order is absolutely critical. And if you say that the financial component is a challenge for you, say that you're not making as much as you would like to make, or say your credit isn't as good as you would like it to be, those are just opportunities for you to partner up with somebody else and let them solve that component. And maybe you do something more on the operational side. So that's absolutely something they're looking for. They're gonna look and identify the people. And just as proof of that is a lot of times the loans that people get when they're moving from residential into the commercial real estate world are gonna be the type of loans that you might get approved, but they'll have conditions. And I'm a perfect example of that. What we did for the first apartment building we bought was we needed to actually have third-party property management mandated. That was a condition of the loan for 1 year, and review of financial statements on a quarterly basis. And it's kind of like training wheels when it comes to lending. So what they basically did was said, yeah, we'll give you the loan, but we want you to abide by a couple conditions. And I still get the letters today. So we did get the loan, but we had to abide by a couple conditions. And that's okay. If that's what it means to take you to the next step of your investing career, then hey, everybody has to do what they have to do to scale in real estate. And that's a really small price to pay to start getting that credibility to move on to the next level. Lastly, I just want to say something on mortgage brokers. In the past, the first few properties I started investing with, and I would just go to different banks and you call up a bunch of people, you try to figure out how to get financing. I since evolved to, I use now virtually one guy, sometimes a second one, but one individual is the mortgage broker that finances most of my deals. And what's great is that you present them with a deal. You say, listen, here's my property, here's the rent roll, get it off the broker that is listing the property, here's the area, how much money can you give me? That's what I do probably once a month with this guy. He's probably sick of me, but hopefully we can make him some money. So mortgage brokers are great because they have the ability to shop a loan around to a number of different providers so that you don't have to deal with, sending out 30, or going to 30 different banks and trying to figure that out. So what BiggerPockets has done is they've put a link below for different loan resources. So one of them is CBRE, which is one of the largest commercial real estate companies in the world, if not the largest. They've got a huge debt department, so that one's down there. StackSource will help you source different lenders and compare them. And Branch Equity has a number of different commercial lenders, and again, they will help you source deals. All right, just to wrap up here, we talked about 3 major lenders. We talked about the regionals, the agency debt, and the CMBS market. And in addition to that, make sure that when you're looking for a loan, you know the asset type, you are coming with your financials in good order, that you're coming with either a partner or yourself that's going to be the person that they lend on. And lastly, make sure that you come with a deal. Don't just call mortgage brokers or go to banks. Actually have a deal. You don't have to have it under letter of intent, under contract, but just something that they can base their opinion on and give you advice. Because at the end of the day, it's the first step to getting a loan is actually finding the deal and underwriting it. All right, that's it for me, guys. Hit the like button, subscribe, leave a comment below. If there's anything in this video you wanted me to expand on, or if there's any other topics you want us to do in the future, just write a comment below. I'll try to get to everybody. And yeah, we'll catch you next time. Take care.